Good morning, listeners. It's a pleasant morning out here in Mumbai with some pleasant and not so pleasant updates here with us. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. Now, to begin with the pleasant ones, India's oil import basket was at the lowest in the past 10 months, majorly on the dwindling demand expectations due to the slower economic growth and the Chinese unrest. Even bank credit growth in the month of September was at 17.2%, quite some good updates for growth. But on the other side, the concerns were seen on the growth side of the trade globally. I mean, there were institutions updating of slowing trade flows and slowing global trade on the backdrop of these lower demands and deglobalization and the inflation concerns. So, what should be the approach, an apt approach, considering all the unrests in China and the slow economic performance, JK?
Hey, good morning. Among whatever you said, I think market is now actually looking at how the authorities are going to respond in terms of their policies. Just to narrow down to the near-term happenings, U.S. market returned after a long holiday weekend and took some risks off the table. Obvious trigger was China unrest that's been seen against the severe restrictions imposed by authorities, which has disrupted social and economic life. While the public reaction may push authorities to moderate some of their stringent rules, we still need to see number of cases reducing to any sort of stability in the situation. There's been some relief as the reports today indicate a marginal decline in numbers compared to yesterday, but it still remains very high. The other potential disruptive development for the market, which we are looking at, is the railroad strike in the US, which intensified, the fears of which intensified after one of the biggest unions joined three others yesterday. Strike could start as early as December 9th, and it won't take long to see the effects of it on the economy. As per estimates, it could cost $2 billion per day for the economy. But more importantly, it could lead to higher inflationary pressures because of supply chains being hit. And if it continues for 1 month, over 7 lakh jobs could be lost as manufacturers who rely on railroad shutdown, pricing of nearly everything increasing, even as the economy is potentially thrust into a recession. Hope is that the Congress would intervene, as they've done in the past, to settle the issue with the unions, and the pressure is definitely increasing on them to act. Yields yesterday posted a very modest recovery. Trigger for the up move coming from hawkish comments from the Eurozone officials, as well as James Bullard, who is, by now everyone knows how hawkish he is. Although China concerns and the stock sell-off stunted the recovery in the yields. 10-year yields trade at 3.70, still more than 55 basis points below the November high. And the 2 to 10-year yield difference still rules about 17 points negative. Stocks were knocked down, taking cues from China news and also indications that Apple's production will be affected due to the troubles there. Big oil price drop also added to the fall in the oil sector stocks. Also, the fact that Powell may sound hawkish again tomorrow led traders to square up positions, having seen a good rally earlier in the month. All the major indices in the US, as well as the global composite stock index, lost around 1.5% during the day. Oil, of course, rose from multi-month lows after speculation rose of a production cut by OPEC Plus, which is meeting on December 4th. So that's adding to more volatility. On the currency side, Euro made a strong push in the European trade and failed just ahead of 105 after hawkish comments from ECB President Lagarde and another ECB member, Klaus Knott. Knott was the one to speak early in the session, saying that recession in Eurozone was not a foregone conclusion, although a weak growth was necessary to fight inflation. Lagarde's comments were even more telling, as she warned against taking peaking inflation, referred high energy costs passing through from wholesale into retail, keeping inflation high, decide on the quantum of rate hike based on updated outlooks, and also in December, they would lay down principles for reducing the asset purchases which they want to cut down. After rallying strongly, euro has been hit by profit taking from traders. Having seen a rally of nearly 10% from the lows, most other currencies also reacted lower, with strength in the dollar emerging after risk sentiment worsened. Fed members Mr. Williams and Bullard were back in their hawkish mode. Bullard reiterated the need to take rates up to 5 to 5.25%. And what's different this time, he's saying that these rates could stay through 2023 and possibly even 2024. I think now the market is probably not taking him too seriously, because the rates remaining at such high for such a long time could see the economy really slumping very deeply. Going forward, market has to some extent definitely discounted the lower inflation number and possible poor data, but the risks of Chinese implosion and the ongoing balance sheet reduction by Fed can keep the dollar shorts at bay. As we pointed out yesterday, dollar has hit the 200 DMA levels, as also other major currencies, and I feel a recovery towards 102 in the euro, 140 and 115 on the GBP is quite very much on the cards, if not anything on the basis of profit taking. Important data to watch today will be the German preliminary inflation numbers for November, which is expected to moderate on a month-on-month basis, consumer confidence and housing price data, which is also expected to show a fall. Tomorrow, of course, will be a big day as we have the GDP numbers as well as the Fed chairman speaking. Just on the rupee, inability to sustain rebounds along with other currency is slightly concerning, having failed to capitalize even with a big fall in the oil price. Recovery in dollar index that looks short-term oversold along with ongoing weakness in Chinese yuan, likely to see rupee push towards 82 in the sessions ahead. Unattractive carry after premiums have fallen below 2% per annum also keeps the sellers away. While the global risk sentiment remains quite brittle, other triggers could come from upcoming GDP numbers and the RBI policy meeting. All in all, we are likely to have a more active trading week this week with so many triggers on the way. Thank you.
Okay, JK. And yes, folks, as JK mentioned, an active week ahead means there's a lot of things to watch out for. And just to watch out for on the immediate front would be tomorrow's day, which will have the GDP numbers coming out, Powell's speech for the further guidance, as rest of the Fed members have been seen being way too hawkish in their commentaries. And folks, we also have the OPEC meeting coming up next week. We've been seeing a lot of volatility in the oil, and there's a lot of dilemma about the kind of demand that there exists and whether there will be any supply cuts or not. So that's another update that the markets would be waiting for. But all in all, as JK mentioned, JK correctly mentioned that DXY has hit 200 days EMAs, and a lot of major currencies have been having some good resistances. So there can be a good possibility of corrections in the majors against USD. And also, if we talk about dollar, the carry not being so attractive, there is a little concern over there as well. So folks, that's about it. The Chinese unrest is one of the biggest factors in the shorter term we got to focus on. So we'll keep updating on those side as well. That's it for today. We shall come up again with tomorrow with another round of updates. Thank you so much for listening.